So I think this is one of the bigger opportunities in the stablecoin space that's kind of like out there for the taking. That you're going to have many folks who build, take like Dollar App, for example, who build this like global infrastructure on top of stablecoins. But that will mean that all these applications will need these last mile providers because consumers who are using Dollar App or businesses who are using Dollar App need to make payments, need to settle transactions in their local currency. And historically, because you were primarily building on top of one single bank in a country, you would just use your bank to facilitate that payment. And now it might be very cumbersome to integrate with a new bank in every single country, to support something like Sling is building. And so you're going to want infrastructure providers that solve this problem for you at scale.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. And today we are recording at Stripe Stablecoin Day live in London. My name is Simon Taylor, Head of Market Dev at Tempo, author at Fintech Brain Food, and today I'm joined by, the one and only Zach Abrams, CEO and co-founder of Bridge. How you doing, Zach?
I am doing very well. Excited to be here.
Good to have you this side of the pond, and really appreciate you. How's life?
It's good. Yeah, I'm adjusting to the time zone, but it's good.
You're doing well. Since the last time we had you on the pod, Zach was on Tokenized podcast about 13, 14 months ago. Lots changed since then, but that was our most popular episode ever, and really good.
Still today?
No, we've grown a bit since then. But you were there at a point in time. I think this is going to be it.
Yeah, we were the biggest crypto acquisition of all time. Very, very short-lived.
Yeah, no. Well, a lot's happened since.
Story of my life.
Just before we dive into some of my questions, I got to remind everybody that views and opinions of contributors today are their own and might not reflect those of companies they represent. And please do not take anything we say as tax, legal, or financial advice, and definitely, in my case, not fashion advice. So, I'm going to remind you that this episode is made possible by Visa and our friends at Stripe. So, Zach, you were just saying that you were once the biggest stablecoin acquisition. How does it feel now? Other people are getting acquired for bigger numbers. Did you sell too soon?
Isn't it obvious? I mean, right now, who could have predicted how big this space would become? And, I think that in many ways, like we helped catalyze, and our acquisition helped catalyze all of this activity. So hard to say, but it is certainly the case that the opportunity is much more clear and much, much, much bigger today, as you look at it today than if you were to look at it a year ago. I mean, if we had this podcast, a year ago, that's why I asked if it was still the number one, because I feel like there were maybe 100 people in the world who were excited about stablecoins then.
Yeah, I mean, I was back at Sardinia, as you remember, and sort of have been in it for a while. And it feels like a few folks like Zero Hash, like BVNK and others have been plugging away. And it was that one thing that nobody seemed to care about except for a few weirdos. And those weirdos are now billionaires. Good on them. But I'm interested, since the last time you were on the podcast, what's really changed in the market? Yes, that announcement. Yes, the Genius Act. But in terms of use cases, in terms of who the customer is, what would you say the biggest difference is now? Who's buying from you, and what problem are they trying to solve?
Well, a year ago, we basically, the market was developers generally outside of the US and Europe who were very small teams, very small products, who had independently come to some conclusion that stablecoins were going to be very important for them or help them serve their markets. And so for us, our inbound interest was like teams of 2 people in Argentina or 3 people in Nigeria. And today, our inbound interest is, large banks and fintechs. And so you couldn't have a more dramatic shift over the course of the last year. And after the acquisition, we like very viscerally felt that, Bridge and the stablecoin space sort of shift along the adoption curve. And it brought this whole new wave of folks into the space because Stripe had sort of legitimized the opportunity. And then when they came into this space, they began to see what all these startups ahead of them had built and the momentum that they were gaining and wanted a part of it.
And what are the use cases that have momentum now? One of my favorite slides from the Stripe tour and sessions was this one I think that Will did, or maybe it was Patrick, of like Stripe's hockey stick growth, and then they overlay Bridge's growth on top of it, and it kind of dwarfs it in the early years. But what's driving that? What is the primary set of use cases, if you could just off the top of your head, top two or three?
If I were to make it as generic as possible, the first is cross-border money movement. So, someone like Felix Pago or Zulu moving money from the LATAM to the US or US to LATAM, or like Starlink moving money from Africa back to the US. And then the second is folks who are building on top of stablecoins as a global financial building block. Before stablecoins, all building blocks were localized. You needed GBP infrastructure to serve the UK. You needed US infrastructure to serve the US. Stablecoins are the first bit of infrastructure that enables you to serve all of these markets on top of one platform, one wallet, one store of value, one card, one money movement integration.
Do you think that with the Genius Act, with these new money movers coming to market, is that a threat to banks, or is it, as Tony from Ubix would say, a gift to the banks and everybody involved?
I think that my guess is that stablecoins will sort of shift the opportunity for banks, and it kind of depends. I think that what will happen is a lot of fintechs will start to be built on top of banks, but that does not disintermediate the need for banks. Money will need to move from this tokenized layer and settle back down into this fiat layer, and so I think that the infrastructure that Ubix is building is really important. I think that banks will continue to be really important, but I also believe that the overwhelming majority of transactions and activity and payment volume and raw number of payments will happen on this tokenized, money layer.
And so, how much is that last mile still an issue in stablecoins? Because that's one thing I always hear from folks in the traditional financial services world. Okay, you've got a dollar stablecoin to a mobile phone in another country, but then what can they do with that? And are cards helping that? Or what's helping?
So I think this is one of the bigger opportunities in the stablecoin space that's kind of like out there for the taking. That you're going to have many folks who build, take like Dollar App, for example, who build this like global infrastructure on top of stablecoins. But that will mean that all these applications will need these last mile providers because consumers who are using Dollar App or businesses who are using Dollar App need to make payments, need to settle transactions in their local currency. And in their case, that's in MXN or in Argentinian pesos or Brazilian reais or Colombian pesos or whatever else. And historically, because you were primarily building on top of one single bank in a country, you would just use your bank to facilitate that payment. And now it might be very cumbersome to integrate with a new bank in every single country, to support something like Sling is building. Mm-hmm. And so you're going to want infrastructure providers that solve this problem for you at scale.
Makes complete sense that you probably want one API to kind of manage that. It's certainly something that's been around for a while. But the other trend, I mean, you announced recently a new product called Open Issuance, but historically this has been a very concentrated market. It's Tether and USDC, and then maybe Athena if you count that as a stable coin, but actually it's more collateral. Does that change? Are you making a bet that that changes? Will everybody issue their own stablecoin, or are we sort of just pushing something up the wrong way and there's a power law here?
Yeah, I mean, I certainly believe it will change. I actually believe it has to change for the stablecoin space to be as big as we want it to be. Right now, the ecosystem is wholly dependent on basically two assets. Those two assets are not super interested in the payments business itself. Like their business models are AUM oriented. So, they make money when money doesn't move. They want money to sit statically, and their business model is collecting the interest. And in fact, they so don't want money to move that both of them charge fees when you want to convert money back into fiat currency. So that misalignment is going to make it hard for stablecoins to improve upon the economics that exist in a bunch of fiat payment experiences. And so you're going to need other stablecoins that want to serve payments use cases and want to serve banks, want to diversify where their assets are held so other people can participate in the underlying economics, and are going to want to be programmable by the underlying users of those assets to serve the use cases that exist on that specific platform. So we think it has to happen to grow the market where we think it's going to be. And over time, I believe that Tether and Circle will get bigger, but have a much smaller share of the overall market. Hopefully they double or triple or what have you, but in a couple years, they're 15 or 10% of the overall market. And we have, thousands and thousands of other issuers.
And then if you've got a long tail of other issuers, there's probably a bunch of fragmentation risk there. How are you thinking about that? And what are you saying when people ask the fragmentation question?
Yeah, so we certainly think there will be a ton of different stable coins. I think that my mental model is that the stable coins over time will recede into the background. So today we're in this weird place where someone logs into a crypto wallet and then they kind of go to the stablecoin store and they can buy, the Circle stablecoin and the Tether stablecoin and the Phantom stablecoin. And that model makes no sense. You're never going to go to the stablecoin store and select amongst 20 different versions of a dollar and pick one based on some arbitrary, decision.
Basically asking a consumer to assess the credit risk of the stablecoin issuer.
Yeah. And it's never going to happen. What will happen is that you will move money from platform A to platform B, and platform B will just seamlessly transition your money into the stablecoin that they are working with. And then you'll move it to platform C, and platform C will seamlessly transition the money. And to give a concrete example today, let's say you are storing money in MetaMask, that's in MUSD, which we help issue. You move it to Phantom. When you move it to Phantom, it'll default into Cash, which is Phantom stablecoin. Then you take that stablecoin, Phantom Cash, and you pay at a Stripe merchant that will settle down into Cash to the Stripe merchant, or settle into USDC on Stripe's platform. So all of this will happen without the consumer knowing that it exists. So yes, the market will be fragmented, but there will be this connective tissue that removes the complexity tied to that fragmentation, much like Visa has done, as we were talking about before, with all of the various banks that exist.
It makes sense. You got to hide the wires. I'm not thinking about how cloud platforms work when I'm using Netflix or YouTube or whatever else. That makes a ton of sense. But do you think that there's a risk that the countries, some of the ones you mentioned in the global south, that are the biggest adopters of stablecoins for cross-border money movement, are you seeing any pushback from local regulators? And is that some sort of risk here that people need to be aware of when they're looking to use stablecoins?
Today there is not that much pushback, I would say. outside of, Europe and the UK.
Weirdly.
Yeah, but in most of the world, there is a lot of regulatory flexibility as folks build with stablecoins. But I do suspect that as stablecoins become a bigger part of all of these economies, it's going to be something that regulators are keenly aware of and interested in, and will treat unique, in a unique way to sort of serve their country's needs.
Where does the sort of existing platform company, ride-hailing company, those sorts of companies, where do they get the most value from something like stablecoins? Is it treasury management? Is it payouts? And what are you seeing and hearing?
Yeah, it's a good question. So, two things, or maybe more. So the first is definitely treasury management. So a lot of these ride-hailing companies, like you take Uber, well, not all of them. You take Uber, for instance. Uber is in a lot of different countries. Like Lyft is only in the U.S., I think. But Uber's in a ton of different countries, so that creates a lot of financial complexity for them. They have entities in all these different countries. They have currencies, foreign currencies in all these different countries. They're collecting payments locally in all these different countries, and they operate primarily in U.S. dollars. They report in U.S. dollars, and so as a result, they're taking risk in all these countries. And we work with Starlink, who has a very similar type of problem. They're selling Starlink in all these different countries. They then work with Bridge to take money out of these various countries and bring it back to the US. So we expect that we'll see companies like Uber work with companies like us to repatriate funds and rebalance corporate money all around the world. I also think what will happen is companies like Uber, it's challenging for them to move money. Moving between all these various entities is not as simple as sending money from, like, if your entity in Japan needs money, it's not as simple as sending it from the US to Japan. For legal reasons, you might have to send it from the US to Mexico to Europe and then to Japan. And all of those are SWIFT payments that take time to settle. So if you need money quickly in a different legal entity, it takes a lot of time. That can easily be solved with stablecoins. The second thing I think that will happen is, like a company like Uber, it is very hard to stand up the unique payment infrastructure in every single country. And so it's sort of, I think a lot of people have heard this story, but like in India, they went into the Indian market and everything was cash based. And so they had to build all this human infrastructure to be able to facilitate cash payments and all the risks that was associated with that. And I think that as stablecoins are, permeate, gain more and more consumer adoption, it will make it trivially easy for the Ubers of the world to turn on the nth market.
Makes a lot of sense, because the complexity has always been, as you said earlier, that everything is national infrastructure, that payments feel global if you're far enough away and you squint, but they are the opposite of that. It's just layer cake all the way down.
Yeah, anybody who's worked in payments know that they are deeply, deeply local.
Indeed. And then there's like a layer cake of different companies that help you with a lot of that stuff. If I'm a neobank, or even a more tech-forward financial institution, should I be adopting stablecoins? And what are my steps to be able to do that? Take a large neobank who's maybe a bit more tech-forward. I know Nubank has stablecoins available. Some folks have done different things. What are your thoughts on the neobank space?
Yeah, I mean, we work with a number of them. So we work with a number of neobanks that are just based in the US. We work with a number of neobanks that are global. We work with a number of neobanks that are regional specific, like in LATAM or Africa. And the use cases are all a little bit different. So in the US, we work with Meow, who is building increasingly on top of stablecoins. They make it so that every dollar deposited into those accounts is yield bearing on day one. So you don't have to move money between all these different accounts to get access to those earnings. They also enable folks to accept, to deposit and withdraw funds via stablecoins, which enables them to serve a bunch of more crypto native companies, which has become a very, very big market for them. The others, if you think about LATAM, we work with a number of folks who are building in LATAM. In fact, there are like 3 or 4 ex-Revolut teams who are all serving that market in various ways.
The Revolut Mafia.
Yeah. And they're building a dollar-based account to serve, consumers or to serve businesses in these various markets. Dollar App is one, but another example is Slash. They're a Brazilian company building a business neobank, and they offer a global US dollar account through Bridge so they can serve businesses in like 100 plus different countries. And we also work with Cleva in Africa, which is doing something similar on that continent. And there was, before working with us, there really, I think we all take it for granted because there's a number of, banking infrastructure companies that we could integrate with to build what we want to build. But if you wanted to serve the African market, there literally is like not a bank that has clean APIs in Nigeria that wants your business because you are just going to compete with them. And they're like one of 2 banks or what have you. So there has not been the underlying infrastructure to serve those markets. So they're building on top of stablecoins and giving them like a world-class, neobanking experience.
But I hear you say that, and I realize why I think the European psychology has been one of risk first, because the European payments regulatory conversation is always about sovereignty, the worry about the lack of sovereignty and giving up sovereignty and the dollarization. And I have some sympathy for that, but I do wonder if that turns around if we start to get tokenized deposits. Just briefly, before we get some fun questions to close out on, your thoughts on tokenized deposits. Are they a thing? Are they a pipe dream? Is it just what banks say in earnings to make themselves feel better, or are they part of the story?
I think that, so for a long time, I could not understand tokenized deposits for the life of me. It just seemed like a worse stablecoin. Like, it's stablecoin, but not yield bearing. Now my view is pretty different. We've spent a lot of time with banks, and it's pretty clear that like they don't want to issue stablecoins. Like the underlying access to the yield via treasuries is not their business. Their business is, lending the money and generating return on those loans, which is higher than the treasury rate, which totally makes sense. So for them, they want to tokenize those assets and then use them to transact. And there is an enormous, while I don't think that consumers are going to be outside of the walls of the bank, would be large users of these tokenized deposits, or at least I'm less convinced of that. I do think that there is an enormous amount of bank-to-bank activity that happens. And that bank-to-bank activity is going to happen via a tokenized asset that the banks want, which is a tokenized deposit.
Atomic swaps of tokenized deposits coming soon to a blockchain near you. Definitely the case. All right, a couple of quick fun ones to finish off. I put out on my social media that I was going to be interviewing Zach, and I asked for questions, and these were 2 of my favorites. First one, how did you get this @stablecoin handle on X?
So we realized, I think we had some lame handle like that was like bridge, like literally bridge DOT XYZ or something like that before. And we realized that @stablecoin was a dead handle and nobody was using it. And so we reached out to the Starlink team because we know that they're owned by the same entity that owns some individual that owns X. Then they connected us to folks at the X team, and we reached out to someone to acquire that handle.
It's not what you know. It's who you know. And then last fun question for you. If you could be a stable coin, which one would you be and why?
I mean, I think everyone would kind of want to be Tether. It's like the fun stablecoin that makes all the money. But I think, ultimately the stablecoin that is like the closest to my heart is going to be the ones that we issue.
You had to say that. I thought it was going to be USDT. All right. I just want to thank our live audience and everybody watching or listening at home so much for listening to this conversation with Zach. Can we give it up for Zach? Zach, if people do want to find out more about you or what you're doing at Bridge, where do they go to do that?
Bridge's handle is just @stablecoin, and I'm at ZC Abrams.
And you can find me at SY Taylor on X or wherever you get socials. Head to fintechbrainfood.com if you like long, ranty British guys' opinions on things. And please subscribe to the Tokenized podcast. Leave us reviews, likes, and all those things I'm supposed to say at the end of a podcast. Thank you very much, and we'll go to the live Q&A for just the live audience in just a second. Bye for now.